Okay, so we're all set for another deep dive today. And this one, well, this one goes to the heart of business. I mean, we're talking about understanding the language of business itself. You know, those financial statements everyone talks about.
Oh, yeah, those.
Right. You send over some fantastic material on financial statement analysis.
Really interesting stuff.
Yeah. We're going to break it all down. We're going to help you see right through, like having, what is it, X-ray vision, right through a company's finances.
That's a great way to put it.
Yeah, to see exactly how things work. Now, we've got these four main financial statements, right? The income statement, the balance sheet, the cash flow statement, and the statement of changes in equity.
The fundamental building blocks.
Yeah, exactly. They're like the cornerstones of any business, you know.
They really are. Like a company's autobiography, they tell the story of its financial journey.
Oh, that's great. I like that. So if you learn to read these statements, then you can unlock some amazing insights into a company's past, its present, and even, peek into the future a little bit.
Absolutely. You can see where they've been, where they are now, and maybe where they're headed.
Right, right. It's like being a financial detective.
Yeah, a little bit. Yeah.
But instead of a magnifying glass, we've got these statements.
Yeah, that's your toolkit.
Yeah, that's our toolkit.
That's it.
So,
yeah.
So where do we even begin? I mean, how do we even start to make sense of all this financial jargon? What even is financial statement analysis?
Okay, so financial statement analysis is basically, it's taking these statements, dissecting them, really understanding what they're telling you about a company, about how they're performing, their financial health, their future prospects, really.
Okay.
And it's not just for, Wall Street hotshots or anything like that.
No.
It's for anybody who's interested in investing, in lending money, in managing a business, or even just understanding, how companies work.
Oh, interesting. See, when I think about financial statements, like I immediately picture, investors on Wall Street.
Right. Yeah.
Like in those movies,
Yeah.
making those big $1 million decisions.
Yeah.
But you're saying that this stuff is actually, it's relevant to everyone.
It really is. Think about it this way. Let's say you're thinking about buying stock in a company, right?
Mm-hmm.
Wouldn't you want to understand, how profitable they are, how they handle their money?
Well, yeah, of course.
Or maybe you're thinking about, starting your own business.
Right. Right.
Analyzing financial statements, that can give you a really good idea of what works, what doesn't work in your industry, See what others are doing.
Oh, that makes a lot of sense. Okay. So let's break down these four key statements then.
Okay.
What story does each one tell us about a company?
All right. So first up, we've got the income statement. Sometimes it's called the profit and loss statement.
Mm-hmm.
And this one basically reveals a company's profitability over a certain period of time.
Okay.
It shows you how much money they made, that's their revenue, and how much they spent, which are their expenses. And ultimately, it tells you, their net income, how much profit or loss they made.
Okay.
One key metric here, one thing to look at is revenue growth. So you're looking at, are they expanding? Are they bringing in more money year after year?
Okay, so if I'm looking at the income statement and I want to see if a company's really thriving,
Mm-hmm.
I would look for a good, healthy, and growing revenue number.
Exactly. Yeah, you want to see that upward trend.
Got it.
Yeah.
All right, what about the balance sheet then? What does that tell us?
Okay, the balance sheet, think of it like a snapshot.
Okay.
It's a picture of the company's financial position at a specific point in time. So it shows you what the company owns. Those are its assets. What it owes, which are its liabilities, and then what's left over for the owners. That's the equity.
Okay, so it's like a scale, like a balancing act.
Yeah, exactly.
With assets on one side and liabilities and equity on the other side.
Exactly. It needs to balance out.
Okay, so assets, those are things like the company's buildings and equipment and the cash they have on hand, right?
Yeah, all the things they own that have value.
And liabilities are the debts and obligations the company has.
Yes, what they owe to others.
Okay, but what about the equity part? What exactly does that represent?
Okay, so equity, that's the owner's stake in the company. It's what's left over after you subtract the liabilities from the assets. It's like the portion of the company that really belongs to the owners or the shareholders if it's a publicly traded company.
Okay, I see. So the balance sheet gives us a snapshot of the company's overall financial health at a particular moment in time.
Exactly. It's a snapshot, a point in time.
Okay. Okay. So what about the cash flow statement? What does that one tell us?
Okay, so the cash flow statement, that digs into the actual movement of cash,
Mm.
both in and out of the company.
Okay.
And it's different from the income statement because the income statement often includes things that aren't actual cash transactions,
Yeah.
like depreciation.
Right. Right.
But the cash flow statement, it's all about the actual cash. Where did it come from? Where did it go?
Yep.
And a really important metric here is free cash flow.
Free cash flow.
Yeah, that's the cash that a company has left over after they've paid for all the essentials, their operations and their investments.
Okay.
Think of it like, your own personal budget. After you've paid for all your necessities, your rent, your groceries, what do you have left?
Right. Right.
That's your free cash flow. What you have to spend, to save, or to pay off debts. Companies are the same way.
Oh, I see. I see. So that's what investors are looking for, right? The company's fund money.
Yeah, in a way, it's the money they have to play with, to grow, to reward investors.
Okay, that makes sense.
Yeah.
Speaking of investors and owners, how does the statement of changes in equity fit into all of this?
Okay, so the statement of changes in equity, it really focuses on how the equity portion of the balance sheet changes over time.
Mm-hmm.
So it tracks the investments that owners make in the company, any dividends that are paid out to shareholders.
Okay.
And then really importantly, it tracks the retained earnings.
Retained earnings.
Yeah, that's the portion of the profit that's kept inside the company, to maybe fuel future growth or to pay down debt. It's kind of like watching the company's savings account, grow or shrink.
Oh, okay, I get it. So we've got these 4 statements, each telling a different part of the financial story.
Right. Different pieces of the puzzle.
Okay, but how do we actually analyze them? I mean, what are our detective tools here? How do we make sense of all these numbers?
Okay, that's where the real fun starts. We've got a bunch of different techniques, each one with its own strengths,
Okay.
For example, we can compare a company's performance over time. So, how do they do this year compared to last year?
Mm-hmm.
And that's called horizontal analysis.
Horizontal analysis.
We can also look at the proportion of each item on a statement.
Okay.
So, like what percentage of their sales revenue goes to expenses.
Mm-hmm.
And that's called vertical analysis.
Vertical analysis. Okay.
Not right.
So it sounds like we're getting down into the nitty-gritty now.
We're getting there.
We are. We're getting into the details. What about trend analysis?
Oh, trend analysis, that's really powerful.
Yeah.
So that's all about spotting patterns over time,
Right.
which can help you try to predict future performance.
Oh.
So
yeah.
for example, if you see a company's profit margin, steadily declining over a few years, that might be a red flag, something to look into.
Right, a warning sign.
Yeah, exactly. A warning sign.
Okay. So we've talked about some of these techniques.
Yep.
Horizontal analysis, vertical analysis, trend analysis.
Yeah.
But you also mentioned ratio analysis earlier.
Right, ratio analysis. That's another powerful tool.
Okay, so what's ratio analysis all about?
Okay, so with ratios, you're basically taking different numbers from the financial statements and you're looking at the relationship between them.
Okay.
And those relationships, those ratios, they can give you really deep insights.
Okay.
They often fall into 4 main categories. There's profitability ratios, there's liquidity ratios, there's solvency ratios, and there's efficiency ratios.
All right. So let's unpack these categories a bit. What are some of the key ratios within each one?
Okay, so let's start with profitability ratios.
Okay.
We talked about the gross margin a little bit earlier, remember?
Yeah, how much profit they make on each sale?
Exactly. So that
Oh.
gives you an idea of, how efficiently they're pricing their products or services.
Right.
Another important profitability ratio is the return on equity,
Return on equity.
or ROE.
Are we? Okay.
And ROE measures how effectively the company is using the investments made by its owners, by its shareholders, to generate profits.
Okay.
So high ROE, that usually means it's a well-managed, profitable company.
So it tells us how good they are at using their resources to actually make money for the owners.
Exactly. How much bang for the buck are the owners getting?
Okay. What about those liquidity ratios then?
Okay, liquidity ratios, those are all about a company's ability to pay its short-term bills, to meet its short-term obligations.
Okay.
So you mentioned the current ratio earlier.
Right.
That's a key liquidity ratio. It looks at, can the company cover its short-term debts with its current assets? So basically, do they have enough cash on hand?
It's like checking if they can keep the lights on, right?
Yeah, exactly. If they can make payroll, pay their suppliers.
Makes sense. All right. What about solvency then?
Okay, solvency ratios, they're looking at the long term. They assess a company's long-term ability to meet its obligations. Can they stay afloat for the long haul?
Right.
And one of the most important solvency ratios is the debt-to-equity ratio.
Debt-to-equity ratio.
And that tells you how much debt the company is using to finance its assets compared to the owner's investment.
Okay.
So a high debt-to-equity ratio, like anything over 2, that can be a sign of risk,
Okay.
especially if the economy takes a downturn.
I see.
Think of it like a company carrying a really heavy backpack.
Okay.
Might slow them down when they need to be nimble.
Yeah, that analogy really helps. So too much debt can be a burden for a company.
It really can. It can weigh them down.
All right. So we've got profitability, liquidity, solvency. What about those efficiency ratios? What are they all about?
Okay, efficiency ratios, they look at how well a company is using its assets to generate sales and manage its operations. So basically, how efficiently are they running the show?
Okay.
And one of the key efficiency ratios is inventory turnover.
Inventory turnover. Okay.
And that tells you how quickly a company is selling its inventory.
Yeah.
So a high inventory turnover, that usually means they're managing their inventory well. They're not tying up too much cash and stuff that's just sitting on the shelves.
Right.
Think about a grocery store.
Yeah.
They've got to sell that produce before it goes bad, right?
Yeah,
It's
absolutely.
like the same principle for a lot of businesses.
That makes sense. It's really fascinating. I'm starting to see how all of these tools, all of these different ratios and techniques, they can help me make, better investment choices.
Yeah.
Or even understand my own business better,
Yeah, so it's the same principles.
Yeah, it's all connected. But are there any limitations to all of this, to financial statement analysis? I mean, can't they manipulate the numbers to make themselves look better than they really are?
You're right to be cautious.
Yeah.
Financial statement analysis is a powerful tool, but it's not perfect. It's not foolproof.
Right.
There are some challenges.
Okay.
For example, accounting practices, they can vary between companies, so it can be tough to compare apples to apples sometimes.
Right.
Sometimes companies have, one-off events that happen that can really distort the numbers, like if they sell a huge asset or something like that.
Mm-hmm.
And yeah, you're right. There's always the possibility that companies try to, window dress their statements, make things look a little prettier than they actually are.
So it's not a perfect system.
Yeah.
But it sounds like being aware of these limitations, being aware of these challenges, that can help us, use these tools more effectively.
Exactly.
Yeah.
Be aware of the potential pitfalls.
Right.
Understand the benefits, understand the challenges, and then you can use that knowledge to make better, more informed decisions.
Okay. That's great advice. I feel like I've learned so much today. I really appreciate you taking the time to break all of this down for us. It's been an incredible deep dive.
It's been my pleasure. It's really important to understand this stuff.
It is.
And remember those financial statements.
Yeah.
They're more than just numbers.
Right.
They're telling a story. And you now have the tools to understand that story, to unlock those insights that are hidden there.
You do. You really do.
So next time you come across a company's financial statements, whether you're researching an investment or just trying to understand a business better, don't just skim the surface.
Yeah.
Dive deep. Remember your toolkit.
Use those tools.
Use those tools and see what secrets you can uncover.
Thanks again.
You got it.
And thanks to all of you for joining us on this deep dive. We'll see you next time.
Bye now.